For decades, the Sydney property market seemed to defy gravity. It was a golden ticket, a one-way bet on ever-increasing wealth. But what if I told you that this entire system, this seemingly unstoppable engine of prosperity, is built on a foundation that's now showing deep, alarming cracks? What if the dream of homeownership in Sydney is turning into a financial nightmare for thousands, right under our noses? The story of how we got here is not just about numbers and charts. It's a tale of ambition, unforeseen consequences, and a critical turning point that is unfolding right now. To understand what's happening to property prices in dozens of suburbs today, we have to go back. Our story begins in the post-war era, a time of optimism and growth. The Australian dream was simple: a steady job, a family, and a house with a backyard. Successive governments fueled this dream with policies designed to make homeownership accessible. First homebuyer grants, negative gearing introduced in the 1980s, and capital gains tax discounts created powerful incentives to invest in property. The goal was noble: to build a nation of homeowners. But this created a feedback loop. As more people bought, prices rose. As prices rose, property became seen not just as a home, but as a guaranteed investment. The Reserve Bank of Australia, or RBA, played a key role. Whenever the economy needed a boost, they would lower interest rates, making it cheaper to borrow money. Cheaper money meant bigger mortgages, and bigger mortgages meant people could bid higher for the same house. For over 30 years, from the early 90s until recently, interest rates were on a long-term downward trend. This continuous flow of cheap credit was like pouring gasoline on the property fire. Then came the boom years. The 2000s and 2010s saw an unprecedented surge. Global factors, like the mining boom and strong immigration, brought more wealth and people into Sydney, all competing for a limited supply of housing. The city became a magnet for international investment. A fear of missing out, or FOMO, gripped the nation. Auction rooms were electric with tension, with properties selling for hundreds of thousands of dollars over their reserve price. Stories of ordinary people becoming paper millionaires just by holding onto their homes became modern folklore. This wasn't just a market, it was a cultural phenomenon. Banks, eager for a slice of the ever-expanding pie, loosened their lending standards. Interest-only loans became common, allowing investors to maximize their leverage with minimal initial outlay. The entire financial ecosystem, from banks and mortgage brokers to real estate agents and governments reliant on stamp duty revenue, became addicted to the rising market. Any suggestion that this was a bubble was quickly dismissed. Sydney is different, they said. There's a chronic undersupply. Prices can only go up. But beneath the surface, the foundations were becoming dangerously unstable. Household debt soared to become one of the highest in the developed world. Wages, however, were not keeping pace. A huge gap was opening up between what people earned and what it cost to buy a home. The dream was slipping away for a new generation. The turning point arrived quietly at first, then all at once. The first tremor was the global pandemic in 2020. Initially, panic set in, with predictions of a market crash. But the government and the RBA responded with the biggest stimulus package in history. They cut the official cash rate to a record low of 0.1%. Suddenly, money was virtually free. This didn't just prevent a crash. It triggered a final frantic surge. Prices in Sydney skyrocketed by over 25% in a single year. It was a party to end all parties. But every party has a morning after. In 2022, a new threat emerged: inflation. The cost of everything started to rise, and the RBA was forced to act. They began the most aggressive series of interest rate hikes in a generation. From 0.1%, the cash rate climbed relentlessly, month after month, to over 4%. For a household with a typical $1 million Sydney mortgage, this meant their monthly repayments suddenly jumped by thousands of dollars. The cheap credit that had fueled the boom for 30 years was gone. And that brings us to the consequences we are seeing today. The impact has been brutal and swift. The very mechanism that pushed prices up is now working in reverse. Higher interest rates mean buyers simply cannot borrow as much as they could a year or two ago. Their borrowing capacity has been slashed by 20 to 30%. This has sucked demand out of the market. At the same time, existing mortgage holders are under extreme pressure. Those who bought at the peak of the market are now facing a double whammy: higher repayments and falling property values, pushing some into negative equity where their loan is worth more than their house. This is the mortgage cliff you've ever heard about. Hundreds of thousands of homeowners on super low fixed rates are now rolling onto much higher variable rates, facing a payment shock they are ill-prepared for. The result? A growing number of forced sales. People who can no longer afford their homes are being compelled to sell into a falling market. This isn't a theory. The data is shocking, and it's happening right now. Let's look at the map. In suburbs across Sydney, from the northern beaches to the southwest, prices are falling. CoreLogic data shows dozens of suburbs where median house values have dropped by over 10, sometimes even 20%, from their peak. Places like Narrabeen, Beecroft, and parts of the inner west, once untouchable hotspots, are now leading the downturn. It's not just houses. The apartment market in areas with high supply is also taking a significant hit. What's most alarming is the pattern. The suburbs that saw the most dramatic, unsustainable price growth during the pandemic boom are now the ones falling the fastest and hardest. It's a classic market correction, but for those caught in it, it feels like a crash. Desperate sellers are accepting offers far below what their neighbors got just 18 months ago. The power has shifted dramatically from sellers to buyers. The frantic FOMO has been replaced by a chilling fear of overpaying, or FOOP, fear of overpaying. So where do we go from here? The situation has revealed the deep vulnerabilities in our system. Attempts to fix the problem have so far been like putting a band-aid on a bullet wound. Government housing affordability schemes often just add to demand without addressing the core issue of supply and credit. The RBA is caught between a rock and a hard place. If they keep rates high to fight inflation, the property market and mortgage holders suffer. If they cut rates too soon, inflation could come roaring back, and the property bubble could reinflate, making the affordability crisis even worse. We are witnessing a fundamental shift, a painful re-anchoring of property prices to the reality of what people can actually afford based on their incomes, not just on cheap debt. So, after all that, what are the key things to take away from this? First, property markets are cyclical. The belief that Sydney prices only go up was a dangerous myth. For 30 years, we were in a supercycle driven by falling interest rates. That era is definitively over. Gravity is finally reasserting itself. Second, debt is a double-edged sword. The cheap credit that created so much wealth on the way up is now causing immense pain on the way down. The level of household debt in Australia makes our economy uniquely sensitive to interest rate changes, and we are seeing the consequences play out in real time. Third, buyer capacity is the new market driver. For years, the market was driven by sentiment and FOMO. Today, it's driven by cold, hard numbers. The single biggest factor determining property prices now is how much the bank will lend a potential buyer, and that amount has been drastically reduced. The great Sydney property boom is over. What comes next is uncertain, but it's clear that the dream of homeownership has, for many, been built on a foundation of unstable debt. The question we must all ask is not when the next boom will be, but how we can build a more stable and equitable housing system for the future, one that serves as a foundation for society, not a casino for speculators. Thanks for watching. If you found this breakdown valuable, please consider subscribing for more deep dives into the economic forces shaping our world. Stay informed, and stay safe.